Welcome back. Let's take a look at the markets in these first couple of minutes of trading. It's been a softness story in North American equities, continuing the pressure we saw yesterday after Fitch downgraded the U.S. credit rating. But it is a fascinating time to look at the global realities, because outside of what debt rating agencies are saying or earnings reports, we've been obsessed with interest rate policy. Already today, you have the U.K. with another hawkish move, raising interest rates. But in the last 24 hours, you've seen Brazil cutting interest rates. Let's put it all in context now with Jeffrey Kleintop, who serves as Chief Global Investment Strategist at Charles Schwab. Jeffrey, it can make one's head spin, but what would you say, first of all, about the mood of the markets coming into August? Let's just start there.
Well, I think the thing that stood out the most to me were that the volatility indexes, whether it's the VIX in the US or the V-stocks in Europe, these are measures that reflect the expectation for near-term volatility, were at their lowest levels since before the pandemic. So traders, dealers were betting on continued very low volatility over at least the remainder of the summer here. And so any surprise, any development that could shake that could really see an outsized move in volatility. And so, of course, this surprise move by Fitch, which doesn't really necessarily shake anything up for the Treasury market, was felt pretty dramatically in equity markets around the world, not just in the US, where the ratings obviously have some impact, but in Europe, even in Japan. And so seeing those volatility levels, investors were just not prepared for any kind of surprise going into August. And so I think we're feeling the effects of that both yesterday and today.
Yeah, and I mean, the stat before yesterday's more than 1% sell-off for the S&P that I had shared from our Bloomberg colleagues, who had gone more than 45 days without a decline of more than 1% on the S&P. So probably shouldn't be surprised to see a little bit of profit taking right now. But again, I mentioned that the interest rate story has been an obsession of the markets with good reason. And here we are on this Thursday talking about one country raising interest rates. We highlighted that Brazil, though, is now in rate cutting mode. What do you make of all this?
Well, clearly we're in a period where central bank policy is diverging. That's very different than the last 12 months when all the major central banks were going in the same direction. We've now got a number that are still hiking, a few that may be moving towards a pause here, maybe have signaled a pause. And now you've got central banks in Latin America, like Chile and Brazil now, are signaling that they're now embarking on cuts. Remember, they led the Fed by 12 months. Back in March of 2021, Brazil began to hike rates exactly 1 year before the Fed, and they ended those hikes in August of 22, 1 year before the Fed. So if that pattern continues, maybe the Fed might begin to cut rates in August of 2024.
Would you say, generally speaking, that would make you feel optimistic about being invested in North American equities, or maybe a bit cautious because of the fact that we've already, at least with the U.S. market, seen quite a rally?
I think that, we've seen quite a rally, and it's been very narrowly concentrated. I know the market broadened out a little bit in July, but it's still very focused. And of course, we get Apple and Amazon earnings today, and the market's very vulnerable to those two companies were they to disappoint for any reason. But I think given that it might be a year till we get any relief on rates, I would say that maybe there's better risk in markets that have lower price to earnings multiples relative to their history. Japan stands out to me. Even Europe, both have PEs below their 10-year average.
What is it about Europe in particular that you're watching outside of the valuations?
Well, Europe has more of a manufacturing focus. I think what we're seeing now is a slowdown in the service sector around the world. The U.S. has much more of a service base to its operations and employment than, let's say, Europe does. And so as we see the service sector begin to weaken, this is 2 or 3 months in a row that the services PMI has come down. I think there's more risk to the U.S. economy than maybe what we're already seeing, which is the manufacturing sector seemingly bottoming out in Europe.
Okay. Final questions more directed at Canada specifically, just in the sense that we have banks and energy companies and mining companies that make up the lion's share of our index. What do you think the rest of the year holds for those kinds of sectors?
I think there's still a very natural resource-oriented perspective, even with the banks. And so, I believe we're going to see more of a balance towards demand pushing up prices for energy and in the commodity space as well, partly tied to El Nino and disruptive effects there. So I see a more positive, a brighter outlook for those commodity prices, which may feed back into the Canada stock market.
Okay, Jeffrey.